It is 8 minutes to 10 on the 1st of May. It's a Friday. We've reached the end of the week, and it's been a very wild week so far. Been very interesting to see all of the earnings announcements from all the companies. I've seen Bitcoin go wild. There's been even more of a disturbance in the energy space. But on today's market broadcast, I brought on Akhil Patel over at Cycles, Trends and Forecasts. And Akhil has a very interesting theory that pretty much all asset prices are driven by the value of land, which is not something that is measured or looked at that much by the broader investment market. But he makes a very compelling case for it. And it all comes down to something called the law of economic rent. It was something that was described by David Ricardo. We'll get onto that during this call. But Akhil, thank you very much for joining me for this one. I hope this finds you well.
It does, and thank you for having me on, Boaz.
In terms of what we're going to discuss today, a few days ago we had Nikolai Hubble, my colleague, on the podcast, and he was telling me that effectively he believes that what he calls the law of economic rent is going to has been fundamentally changed by the Wu flu, effectively, because everyone's on lockdown. And when you're in a big city, of course, the virus has been able to spread a lot easier. All of the advantages of being in a sort of cosmopolis like London seem to be reduced quite heavily. And he thinks that because everybody is staying indoors all of the time, everyone is ordering everything from Amazon, where where Amazon is located, the warehouse and the like isn't nearly as important as where a supermarket is located near to you, because everybody is relying on these things that are less dependent on being close proximity within the city. Because of that, the value of land inside the cities and the value of properties inside the big cities is going to decrease by a large margin. What do you make of that? And before you go into that, could you describe for our listeners what the law of economic rent is and why it is that you value it so much?
Okay. As ever, you start with a really big question, Boaz. So the law of economic rent was first formulated by David Ricardo in the early 19th century. He was actually studying the agricultural economy, as you know, the UK and most economies were then. And he basically pointed out that you need a certain amount of return from a piece of land to induce someone to go and buy a spade or some sort of farm equipment and pay a person to work on the land. But that over and above whatever that yield would be, you found that certain pieces of land yielded more, a surplus, in other words. And that surplus was related to the gifts of nature. So in other words, to location where you might have particularly fertile soil, or it might be in a particularly sunny spot and gets a certain amount of rain. And that surplus was, in effect, economic rent. And he pointed out that that surplus ultimately ends up in the pocket of whoever owns that piece of land. That sort of concept was taken forward by an American economist called Henry George, who was analyzing the depression of the early 1870s. And he applied it to what goes on in the industrial economy and in cities. And he said that one of the reasons why economies go through a boom and bust cycle is because you get speculation in land, and the surplus of progress is always ends up in the land market. It induces speculation. It drives land prices up. It squeezes the economy. So business profits and wages get squeezed, and people and businesses can't afford the rents that they're being asked to pay. And ultimately, the economy can't take it anymore. And then you get a major collapse and a period of recession or depression until such time as things adjust, and then the process can start again. In the 20th century, we then found that banks got in on the act and lent money towards people to acquire property, driving prices up even more, and in the process exposing the banking system to the downturn. And so you get major sort of collapses, as we saw after 2008. And so fundamentally, land and the law of economic rent is what drives economies through the boom and bust cycle. In some senses, it's quite a simple concept, but no one really talks about it. And the reason that no one talks about it is because no one really studies land. And one of the reasons why no one studies land is because for some reason, and it's actually something I've written about in my newsletter, after the time of Henry George, neoclassical economists stopped studying land as a factor of production in its own right. And so it's sort of hidden from view, and then you can't sort of diagnose the boom-bust economy as a result.
Yeah, I found that very interesting. You've drawn up quite an interesting conspiracy as to why it was that land was deliberately obscured from economic analysis, and that it is quite an interesting factor in of itself. Why nobody speaks really of land prices while everyone is obsessed with property prices in this country. But
Exactly.
on the topic of how the lockdown is going to affect the grander cycle that you describe and land price in general, and that entire system of the law of economic rent, because when we're talking about land, and when you talk about it, you're generally talking about it in the context of economic centers and cities and the suburbs surrounding that, and the way that booms can sort of draw the amount of land that is used for economic activity. It expands that around cities, whereas land in the middle of nowhere is the value of that doesn't really change all that much. Can you describe a bit how how that functions in the first place? Why it is that it's land in the cities that is the basis of all the speculation, and how that differs from land in the countryside, for example. But also how the lockdown how the lockdown could change this dynamic somewhat.
Yeah, so the general point is that land is most valuable where people want to be, and people want to be in places where they can get jobs and they can have access to, local amenities such as parks and shopping and other things that we all need to be close to enjoy the life that we want to lead. Now, I suppose that's fundamentally the reason why certain locations get particularly valuable. And then that kind of kicks off the process, which I described a couple of moments ago, in terms of, greater demand for living or working in those locations drives up makes those locations more valuable, drives up prices in those areas, which then induces kind of speculative activity. And incidentally, land is the only asset where you can basically do nothing with it and still it can go up in value. Unlike, if you have a piece of equipment to, build something, if you don't use it, it sort of wears and tears. And similarly, if you have if you're employing people and they're doing nothing, they're not, going to de-skill and so on. So, but land is a unique factor of production. So that's kind of the process. Now, it doesn't mean to say that once something is valuable, it will always be valuable if tastes change. And this, I think, speaks to the point that Nick was suggesting, is that maybe London isn't quite the center of the world in the way that we thought about 3 months ago. And maybe people do want to have more space and be less close to so many people and want to be close to a big park or something like that. And you don't really get a few of those in the center of London, but not too many. You might want to be in the countryside. But then that will induce the same kind of process in whatever locations people end up choosing. And it's not the case that everyone will live sort of half an acre away from their neighbor. It's going to be that, it might be a more decentralized sort of economy that we ultimately get to as a result of people thinking through the risks of being so close to a lot of people. But then you'll get those locations getting more valuable and then inducing the same sorts of process as you've seen at the center of cities over the last decades. Now, personally, I think that thesis might be slightly overdone at the moment. We don't really know. It's far too early to say, barely sort of 2 months into a lockdown, how tastes are going to change. And of course, what the impact might be in people's views when a vaccine is widely available, or there's some new etiquette of getting on the tube, everyone wearing a face mask, and maybe that will mean that we can all go back to some semblance of normality. But even if it were the case that there are going to be sort of fundamental shifts in location, economic rent will appear in those new locations where people want to live and work.
When I spoke to Nikolai about it, I thought it was a similar sort of democratizing force where you'd see more of the land value just shift from the cosmopolitan centers out into the countryside. But his view was effectively that there is so much land that is relative to the amount of land within the cities that it would the value of land outside the cities is so vast that the actual impact of people leaving the cities to then go and buy land out there wouldn't even raise the value of that land quite so much, or it wouldn't raise it enough for it to be even noticeable. What do you make of that?
Well, I think you just have to look at places like Florida, or which has, or the United States in general, which has a superabundance of land relative to the size of the population, and yet they have enormous bouts of speculative activity as people zone bits of Florida swamp for housing, and then sort of everyone piles in because it's the next new location to be in, and it sort of drives prices up to enormous heights, and then it all collapses again in the ensuing bust, and then it nothing happens for several years, and the process starts all over again. So historically, it's not the case. I mean, you do fundamentally need to be close to something. You're not literally in the middle of nowhere, and wherever that something is by definition limited, because if someone owns one piece of land near a chain of high street of shops, and a pub and a post office as you get in a sort of village, and along a road which gets you to places you want to get to, there are only so many sites within, say, a 5-minute walking distance or a 10-minute walking distance, and so those sites become more valuable as people move in, and the ones that are further out are not as desirable. So it's either a case of having a slightly lower quality of life because it takes you longer to do things, or you move to the next, you find a place in the next village along the road where that process can start again. So fundamentally, all economic activity is location based, because we have a system where we have division of labor, and one person makes shoes and the other person sews trousers, and so on, and we exchange products and so on. So you need to have proximity of some sorts to have that, and that's where the value of location arises at fundamental level, and that won't change.
Yeah. Does it not? Will that? Well, you say it won't change, but is there not an influence on the sort of the efficiency of businesses like Amazon, where they can have these gigantic warehouses way out in the sticks, and then they, with a great ease, they can deliver very far and relatively quickly into the cities? Does that not affect the whole issue of proximity within this idea, where you need to be really close to, say, post office, coffee shop, etc., things like that?
Well, I mean, I think you're finding with Amazon that, I mean, there was probably a period in the 2000s or the 90s where being close to post office wasn't that useful unless you were a pensioner needing to use it as kind of a bank. But now you actually with the Amazon economy, you need to be quite close to the post office, because you need to post your returns back to Amazon. If you don't, people buy stuff without really knowing if they want it. They get it, and then they realize they don't want it, so they need to get back to the post office to post it back. So my point is simply here that actually location shows up in interesting new ways, and Amazon is quite a good example, and the whole idea of logistics. And this kind of shows that as economic sort of fashions and practices change, locational value will show up in different areas. So there is such a thing as, I believe it's called the Golden Triangle, which is an area somewhere in the Midlands from which a lorry can drive pretty much anywhere in the country within one single shift of a lorry driver's kind of practice. So basically, it makes an ideal location for logistics and the most efficient thing. So a lot of logistic kind of houses are set up there, which obviously then means that a lot of employment is going to be sort of dependent on that, and then people are going to set up there for kind of housing and so on. And so the centre of Birmingham has effectively become quite a valuable part of kind of a set of real estate in its own right, partly because you can, and soon we'll be able to commute to London quite quickly compared to how it was a few years ago, but also because a lot of companies are relocating different functions to that area. So yes, proximity, I think, is important in different ways, and that shows up in local property prices. And actually, I think the other thing, just to go to the point about, well, people might be moving out of London, but if the London economy is well served by what's going on in Birmingham, because you have people who can commute into London, and all your deliveries can be done efficiently out of Birmingham to serve the London economy. Actually, what we've found is that London property prices have been are themselves benefiting from that, because you get a more efficient economy. And so, as I pointed out, it's the surplus of economic activity which ends up reflected in the locational value and the economic rent.
Very good, very good. I think I'm done fighting Nikolai's battles for him for the moment, Akhil. I would like to transition a little from that point you speak about with proximity and how the importance of location. And this is quite a big gear change. It does relate to something we actually spoke about a couple of years ago. But interestingly, I think it's kind of relevant to this prospect of land. So.
Yeah.
Of course, we see these days there's the phenomenon of the gigantic Amazon warehouse, which is located, in these sort of logistics centers that are. So they seem to be in the middle of nowhere almost, but they're actually very efficiently located. In terms of so another of these vast buildings that is very much a product of the 21st century, and which is this sort of new phenomenon, is that of the data center, right? Cloud storage centers. These are also huge, vast buildings that are located. They spring up in all these interesting locations around the world and in this country. And they're all based on it's all based on our demand for the internet. When people speak about the cloud, I mean there is actually a physical limitation to this. In the building and the construction of these gigantic server farms, and so there's a huge investment opportunity in this, where you've got there's even an ETF now called I think the ticker is Sky with 2 Ys, which is a cloud computing ETF, and all it does is they just buy stuff that they buy companies that are invested in the business of cloud computing to some degree. And some of these are simply, they own huge amounts of server farms, and they put them in these massive warehouses, which nobody ever thinks of when they access the internet or access a website. But these are huge buildings that take up huge amounts of land, cost huge amounts of rent. But in the same way that I see it as, but you can correct me, I see this as the construction of all these servers. These guys are harnessing the law of economic rent, but for cyberspace. Effectively, they are earning the rent of the expansion of cyberspace, because all of the websites that get built, all of the images that get uploaded to the internet, they all need to be stored somewhere. And of course, that means somebody is going to install a server, and they are going to use the electricity to run it, and they will earn the rent from the person from the website owner who needs to store all that space. And it seems like the law of economic rent is in action, as it were, with the internet, but in cyberspace. And it's all these cloud computing companies that are earning it, and they're vast rents. I mean, the profitability for some of these companies is extreme. Interestingly, AWS, which is Amazon Web Services, that's 50% of Amazon's revenue. And everyone thinks about all these deliveries that are going to everybody's door, but half of the company is simply from effectively hosting and owning all of these server farms and securing it. I believe the margins are over 30% that they earn just on this stuff, and yet they make up a tiny amount of Amazon sales. It's really quite impressive. But I want to know what do you make of this? Do you think that is a similar dynamic where it's the law of economic rent, and these guys are just the sort of the land speculators of cyberspace?
Yeah, no. So I think you've encapsulated that issue perfectly. So the law of economic rent is inescapable. We all need land to live and work on, and the whole sort of idea about the internet-based economy would be that location was irrelevant, but actually it shows up in very different ways than you might have been expecting. And so yes, a server farm needs to be located near the main routes for internet traffic, and so I gather, and I don't know too much about this, but there's a major trunk route running up and down the center of the country, and proximity to that is where most of the major kind of server farms would be located. So in those areas where there's and I don't know physically the scale of these buildings, but I imagine they're enormous. People who own the land in those locations, while there might have been not very valuable 20 years ago when the internet economy was in its infancy, they're now extremely valuable because the sites are limited and they have to be in a certain location to effectively provide the kind of connectivity services that you need. I mean, the other area within the internet-based economy, particularly with mobile phones now being so powerful, is the electromagnetic spectrum. So, when we talk about land, we don't just mean physical Earth. We also mean anything supplied freely by nature to be able to be used to serve human kind of desires and wants. And so the electromagnetic spectrum of which the mobile economy runs is also effectively, it's classic kind of economic rent. There's only a limited amount of the really valuable bandwidth, and it gets more valuable as the internet economy develops. And this is one of the reasons why when governments have their act together and run sensible auction processes and companies are bidding for them, governments are themselves actually managing to recover some of the economic rent that arises from ownership of rights to use certain parts of the electromagnetic spectrum. So it appears in all sorts of guises. And in fact, that probably will end up, as we develop as a society, as a global economy, that will end up being probably almost the most valuable real estate there is in an economy.
Yeah, it seems like the more the internet expands, the more it's going to become ever more important and probably ever more noticeable. Just how much wealth it creates, and it seems almost inadvertent that it would create these very high property prices in this along this trunk through the middle of the country. And yet it seems like things like that are going to become more and more noticeable as time goes on. People seem to think that the vast wealth that's been created by the internet is sort of limited within the tech space, with the likes of the early investors in Amazon and Google and the like. But it really does seem to permeate. It seems to be permeating pretty much everything, right?
It does, but I mean, as you said, Amazon's the highest margin activity is effectively renting out space. And Google, I think, to a certain extent, does something similar. So it's built its entire business of, people being able to access the internet efficiently, and they effectively created digital real estate, through their sort of search engine, which then brings a lot of eyeballs, which then generates enormous quantities of advertising revenue. And advertising revenue in itself is a function of economic rent. Because you have a lot of people in a relatively small location looking at the same thing, and so the returns to those who own that space is enormous. Yes, as the internet economy develops, you will see more and more of this. It becomes more and more valuable, and then as things get more personalized, and the potential is endless. What's also interesting is I've started to see signs of is that. Internet companies sitting on these vast pools of cash have started themselves to almost get into physical real estate. So looking at how to build efficient housing and lend money to people to buy things, and then eventually it'll probably become mortgages, because as banks have found over the last 200 years, lending money to people to buy a piece of land at interest over 20 years is actually enormously valuable activity. And once they pay the loan off, then you can find the next person to buy that same piece of land and earn interest for another 20 years. So it just goes on and on and on. And it's all fundamentally driven by this idea of economic rent.
Yeah, it's fascinating stuff, Akhil. I think it's interesting to see also, you've got some of the big tech majors, you say, with all the cash. I think Apple, with their earnings releases and their earnings announcement, it was revealed they've got something like $190 billion in cash. Seems pretty extreme, but they're going to have to do something with it sooner or later. And most of these have all registered as banks now, because they're trying to get in on the fintech space as well. But changing gears just slightly once again, we are running a long time. I know you're a bit pushed, so I'll cut to the chase somewhat. You described before we went on air that what has happened as a result of the pandemic is actually driven somewhat by the real estate cycle. I mean, this is sort of an aspect or a symptom that emerges from the real estate cycle in general. Could you expand on that for our listeners, please?
Yeah, so I mean, in a sense, this is sort of an emerging kind of idea in my mind. I wrote about it a couple of weeks ago for my readers of Cycles, Trends and Forecasts. But essentially, so what happens as an economy develops, and this is in relation to agricultural economy, but the bigger players own the best sort of locations as they become more valuable. So you get big agribusiness organizations owning, say, the best farmland in China. And that pushes smallhold farmers out to the margins. And it just so happens in China that brings them into contact with wilder animals. And there is also, in parallel, a fashion for eating kind of wild meat at the moment. It's become a bit of a luxury item. And so smallhold farmers have been pushed to marginal lands and therefore not able to earn as much yield off the land, have been sort of potentially finding luxury items in wild forests to bring to market, and it's in these markets where viruses can spread rather easily, or indeed they might even come into some of these big agricultural farms where they can spread through kind of more domesticated livestock. And because you have big global supply chains, they then get into that and then transmit around the country, around the global economy rather, very quickly. It's actually a process that was first documented for the HIV virus back in the early 20th century. So we've had that for about 100 years. And it started in the German Africa or Belgian Africa with indentured labor that were working in the lumber industry to serve the kind of European population, then starting to eat bushmeat, which maybe they hadn't done so in quite the same quantities as before, but they were right at the margins of cultivation. And that's allegedly where the HIV virus entered into the human population and then spread into around the world through, supply chains that were riding across colonial Africa. So it's kind of a process that actually happens over and over. And it's ultimately the bigger players dominate the best locations, push other, and this is kind of the process you see in the real estate cycle, push other people to more marginal locations. And then in this case, unfortunately, the interaction between kind of wild animals and humans becomes more prominent and therefore can induce the transmission of diseases and so on. And there is some sort of fairly significant documented evidence that this happens, though I'm not myself an expert in virology and don't know the exact processes and where things might happen more easily and where they don't and so on. But I thought that was quite interesting, and it's to me kind of rings true because you see the same dynamic, obviously, albeit in a very different context in the urban economy as well. Yeah,
it is interesting to make that comparison with the origins of HIV and how that spread as it did from as you say in the Congo through to the developed the more developed world through the sort of colonial paths there. One last thing before you go, Akhil, if I may, in terms of the we've got the big shutdown here in London, and as we've been discussing, it may well be that some people would prefer to move out to somewhere else, just in the event that this would happen again, or simply because they realise that when they're stuck down in isolation, maybe some fresh air every day would be slightly more preferable. In that. Following that view, are there any areas in the country that you think will actually benefit as a result, specifically of sort of the lockdown phase, and that sort of tie into your broader real estate cycle framework?
Yeah, I mean, I'll start with the last bit first. So, I mean, what you tend to find within each real estate cycle is that the first half of the cycle, and we've just got to the end of the first half, the kind of the real sort of price gains, at least in relative terms, are in the biggest cities or in the center of cities. And in the second half of the real estate cycle, which we should enter into in the next year or so, you find that it's sort of secondary and tertiary cities that do better than, say, the primary cities, and also the outer parts of any city does better than the central parts, at least in terms of percentage gains. I mean, everything tends to do well, or most things tend to do well in the second half of the real estate cycle. So I'm expecting that kind of dynamic anyway. And in the last equivalent cycle, for example, even though property prices in London almost doubled between 2000 and 2007 in London, they did more than that in, say, the northeast and the northwest, and in particular in Northern Ireland. So that's one sort of dynamic which is very much part of the real estate framework. As to what will dictate fashions going forward, given the context of global pandemic and people being afraid of it. I mean, I think it's a bit early to say. I mean, being a bit speculative, you still want to be near or within easy access of work opportunities, and it seems that companies are relocating to places like Birmingham, to Manchester, to some of the sort of cities across the northern belt, which George Osborne was going to try and create a sort of a major kind of cluster city, as it were, with his northern powerhouse idea. I suppose you would kind of still want to be within proximity of those places if rail links are upgraded and so on. I mean, that would definitely be places to look at. And then it's kind of what your particular brand of fresh air that you like. Is it by the sea? Is it by a big forest? Is it near some hills and mountains? I don't know. I mean, it sort of rather depends. I suspect it will be where prices are still relatively reasonable, but where companies themselves are looking to relocate. And so Birmingham and those northern cities, I think, are kind of where the action will be, at least in England, and maybe potentially post-Brexit, some Northern Ireland might do well because it might have the ability to access more easily the European market. Has given any specific arrangements, but also has full access to the UK market, and that would repeat what happened in the last cycle after the Good Friday Agreement, which kind of really settled things down and enabled people to invest. So yeah, I mean, it's going to be a range of areas. And the other thing is, the government themselves have said they're going to be shifting activity out of London, and so government employment tends to be quite important for smaller cities in the UK, and so wherever the government ends up doing that will also, I think, benefit.
Yeah, I heard the Bank of England is planning on setting up an office in the north of England. All part of this big drive to sort of democratize government power, I suppose. But no, I think that's very interesting, Akhil. The Northern Ireland story I find very interesting. The sort of regulatory arbitrage opportunity there, and the properties there are very cheap relative to the rest of the country. It will be very interesting to see how it all turns out. But Akhil, I know you're pressed for time. We shall leave it there. But thank you very much for joining me today.
Thank you for having me.
That was Akhil Patel of Cycles, Trends and Forecasts. I hope you enjoyed listening to that. I always am fascinated by Akhil's views. But that is the end of our market broadcast for this week. And we will not actually be back on Monday. We'll be back on Tuesday. There's some other activity in the business that requires our great sound engineers here at Southbank. So I won't be here on Monday, but we shall be back on Tuesday with another of these market broadcasts. In the meantime, hope you have a very good weekend. Hope you're keeping your sanity during lockdown. I'm doing my best as I can over here, but hopefully I'll make it through to Tuesday. But we'll see you then. Have a good one, and we'll be back then.